Hey everyone, in this video, I'm going to discuss two things of vital importance for NEO stock investors. The first being the company's gross profit margin. In the latest quarter, the gross profit margin and the vehicle margin fell back below double digits again, and investors were disappointed in this. Management had told investors double digits is where it was heading, and now it's back below. So I'll go into some detail about NEO's profit margin. Secondly, I'll go into NEO's battery technology, the investments from outside investors into NEO for the battery investment, and what that will mean for NEO's battery technology going forward. So those are the two things of vital importance I'll talk about for NEO stock investors in this video. Let's start with the vehicle margin and the gross margin. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so there was a question from Tim Sao, a Morgan Stanley analyst, asking about, telling the NEO management team, look, I had a question about the gross margin because, as you remember, the company previously told us that gross profit margin will be back into the mid-teens. They were telling us 15%, 18%, but we saw the gross profit margin actually fall in the most recent quarter. Let me show you where it was. Okay, so here you see in the latest quarter that vehicle margin came in at 9.2% in Q1 2024, and the gross profit margin came in at 4.9% for the first quarter of 2024. So that was both down from the previous quarter, but they were up from the previous year. Year over year, those margins were higher. So still, the company is making improvements in its vehicle margin and gross profit margin. So the analyst is asking, we saw you increase promotion, and do we need to revise down our profit margin expectations from NEO? Should we lower our expectations? And the NEO management team answers this question. They say, yes, regarding the gross profit margin, more promotions were offered to the automotive segment, leading to the decrease of our average selling price in the first quarter. So they needed to have more promotion. But the unfortunate part was that in the first quarter, vehicle deliveries were actually down year over year. So even though the company offered more promotions, they sold fewer vehicles. And that just goes to highlight the increasing competition in the industry. You have to offer more promotions, more incentives, lower prices just to stay afloat, just to be like flat or down a little bit. All right, so that's a little disappointing. And further, more lower margin models like the ET5 and the ET5T were sold in Q1. These generate lower profit margins, and so when more of these models sell, that lowers the company's overall profit margin. CEO and co-founder, Stanley Q, not the CEO and co-founder, goes on to say, we expect the vehicle margin will return to double digits in the second quarter. That's good news. And continue to improve in Q3 and Q4. So it's going to bounce back up in the second quarter, and then from then, it's going to continue improving. But still, considering the intensifying market competition, we will also be more flexible on sales policy to make sure our market position is secure. In other words, this is the NEO management team being very strategic with their forecast and what they're saying, because you better be sure that when a company as large as NEO is discussing what it plans to do for the rest of the year, the competition is listening. So if NEO was to just talk about, we're going to have these profit margins and this is our plan for profit margins and they're going to increase throughout the year, competition can look at it and say, oh, that's interesting. They're going to focus on profitability. That means we can go after market share. We can lower our prices and go after market share because NEO is not going to retaliate. They just want to get profit margin. They're not going to focus on market share. But the last sentence here counters that. That's the NEO management team being very strategic, saying for the competition, right? This is directly aimed at the competition, saying, considering the intensifying market competition, we will also be more flexible on sales policy to make sure our market position is secure. So if you're thinking about lowering your prices to take market share from us because we're trying to increase our margin, then we'll come right back at you. We'll lower prices too. We're not afraid to battle for market share. We're not being stuck on this focus on profitability. So I like that from a management team. I like that they're being flexible. I like that they're thinking about competition because strategy is important. You're in a game, you're in a market. If you go down a certain path and you're not flexible, your rivals will take advantage. And so you don't want to lock yourself in to a certain strategy, a pricing strategy for the year, without saying that, look, we're going to be flexible. We're going to adjust if we need to. Okay, so moving on to the second part of the video, which is discussing the power segment. So Neo Power secured a strategic investment of 1.5 billion. It should be RMB, not dollars. And in USD, in dollars, it's 200 million. So the management team saying that after this round of financing, Neo still has around 90% equity in Neo Power, and Neo Power is now open for external investors. So they're attracting investment from outsiders to help Neo develop this because it's very capital intensive. A lot of money needs to go to build this out, and it's just in the very early stages of development. So Neo would have to invest a lot of its own capital if it didn't attract outside investors. So by attracting outside investors, it allows Neo to expand this network more fully and lower the risk. So Neo goes on to say that we needed to build up the network for power swap facilities, but the upfront investment is heavy. And it's true, it's very intensive. We do see a clear roadmap for profitability with Neo Power, but right now the break-even point of our single power substation, it's around 60 swaps per day. That's where they need to be just break-even. Right now, they're around 30 swaps per day. So they're at roughly half of where they need to be in order to generate break-even with their current power stations. So a long way to go, a lot of investment needed. But these investments help sales because if you have a power swap station nearby, a customer is more likely to buy a Neo car because they feel confident they could go to that power swap station and swap batteries when they need to. So it's not only does it generate revenue on its own, but it also helps facilitate sales of Neo vehicles. And the outside investment, I like this strategy because Neo overall is a very risky investment. It's a very risky stock. It's a very risky business model. They're going after everything all at once. It seems like they're selling all of these vehicles. They want to invest in the power stations. They want to provide the power also. They also want to open and start sub-brands, right? They just started the second brand. They're going to start a third brand. And then they also want to invest in the driverless technology. So they've got all of these things happening all at once. That's very risky. That's a lot of capital that needs to go out. Of course, it's very risky, but it also has a really high upside. And so with this investment, with this outside investment, what it means for Neo stock investors specifically is that it lowers the risk of the business because you get outside capital, but it also lowers the upside, okay? And the lowering of the risk and the lowering of upside is small, relatively speaking, with this one investment. But if this continues and they allow to sell more equity in that segment, then that can continue further lowering risk and lowering upside. Either way, I would like, if I was a Neo stock investor, which I'm not, I would encourage Neo to follow this strategy, to bring in more outside investment, to lower the risk of the business. In my opinion, this business is on the highest end of risk, and it should focus to decrease risk in marginally, right? You don't want to give up too much upside, but when you're operating at such high risk levels and you're losing so much money on the bottom line, it makes your survivability difficult. And so if you can just on the edges lower the risk and lower the upside, I think it's worthwhile when you're all the way to the extreme of the risky spectrum. So I think that's a good move for Neo. I think it's a prudent move, and I would be pleased with that if I was a Neo stock investor. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.